Welcome students. So in the last class we were talking about factoring of the flotation cost, and I told you that flotation cost has not to be say factored by working out the weighted average cost of capital, but maybe in some other way we have to factor it into the one time investment, and that one time investment is the project investment or the total cost of the project, rather than revising the weighted average cost of capital. Because if you factor into the weighted average cost of capital and revise the WACC, in that case WACC being a annual cost will be say going up, and one time cost, that is the flotation cost being one time cost, you are mixing up with the annual cost, so you are increasing the annual cost. And sometime because of this increased or miscalculated weighted average cost of capital, your even a good investment opportunity may give you the negative results, because NPV may become negative, because your expected rate of return from the investment may be lesser than the weighted average cost of capital, and finally we can reject, or we may reject the investment opportunity, which is otherwise not correct. So you have to do it in a way that you have to leave the say weighted average cost of capital untouched, and you have to do something that the flotation cost is factored into the project cost or the total investment of the project, and the WACC is kept like that. So for example, as we saw in the previous class, that the WACC was 12%, and when we added the flotation cost of 6% into the WACC, and we reworked out the whole WACC, so it became 12.77%. But for example, you think out a situation that the expected rate of return from that project is 12%, WACC is also 12%, so NPV will become 0, and maybe in the subsequent years the cash flows coming out of the projects may be very high or positive, and the overall investment opportunity is acceptable. But when you revise the WACC from the 12% to 12.77%, and if the expected rate of return is 12% only, so what will happen? Your investment will become a negative investment, NPV will become negative, the expected rate of return would be 12%, and your say from the project is 12%, whereas your required rate of return will be 12.77%, because your required WACC has become 12.77%. So you would say that my NPV of the project is negative, and since the required rate of return is more than the expected rate of return, so even a good opportunity can be rejected, and we may not go for making this investment. So advice is that not to use this process, you have to not to use it, you have to keep the WACC as it is, not to revise it, and you have to factor the flotation cost by some other way. And what is that some other way? We are going to discuss that. We are going to learn that how to factor the flotation cost being a one time cost, and how that has to be added into the project investment or the total cost of the project. And for that purpose, we will take the hypothetical values. So for example, a project investment requirement is project investment requirement is equal to 200 million. Right? You require to make investment into any project, that is investment requirement is 200 million, and the flotation cost is 8%, right? Flotation cost is 8%. When you are raising these funds from the different sources, it's going to cause the cost, flotation cost. And for example, we assume here that we are not going to raise the funds from multiple sources. This 200 million is totally equity based. This is totally equity based, and only funds are coming from equity. This is not coming from the multiple sources, but because you are going to raise the funds from the equity or through the equity, or you are going to use the equity route, still you have to pay the flotation cost, and the flotation cost is 8%. So in this case, for example, if you raise 200 million rupees and pay the 8% as the flotation cost, so how much is left with you? You are left with only 92% of the funds raised. So it means 92% of 200 million will be something called as 184 million, and your requirement is not 184 million, but your requirement is 200 million. So in that case, you will fall short by 16 million, because you paid that 16 million as the this 16 million as the flotation cost. So it means the total investment requirement of the project will not be met. So in this case, you have to work out in such a way that the total amount to be raised will not be 200 million, but more than 200 million. And how much will be that 200 million after factoring the flotation cost? We have to learn about that, because both are one time costs. So it's better to sum up the flotation cost with the investment cost, rather than means adding it into the WACC, weighted average cost of capital, and revising that WACC and mixing up the one time cost with the annual cost. That would be incorrect way. So now in this case, how to factor it into the investment total investment requirement of the project, we will have to learn this. And for this purpose, for example, we are going to learn about total amount to be raised now, means including the factoring cost, total amount to be raised for the project, for investment, you call it as total amount to be raised for investment, total amount to be raised for investment. So in this case, we are going to raise this amount for the investment, and so this amount to be raised for the investment is, we have to follow a equation, we have to follow a model. So what is the investment requirement for the project? It is 200 million. So you can follow this equation, and this is going to be something like that. That is 1 minus 0.08, that is the flotation cost, multiplied by the amount to be raised, or you call it as the total amount to be raised. And this in this amount you will be including the flotation cost also. So amount to be raised would be the total amount, which will be including the investment requirement also, and which will be including the flotation cost also. So that will be something which is multiplied by 1 minus 0.08. So that means we have to make it something equal to the 200 million. Finally, means we are left with the 200 million. So just to have this 200 millions of the investment amount available with us, and after paying the flotation cost of the 8%, this amount should be left with us. So how much amount we have to raise? So we want to answer this question. So in this case, if you solve this, you will find out amount to be raised, right? Amount to be raised would be how much? This is going to be something like, in a way, that is rupees 200 million, and it has to be divided by 1 minus 0.08. If you divide this by 0.08, this will work out as rupees 217 point. This will work out as 217 point. This will work out as 217.39 million, right? This amount you have to raise. So this will be 217.39 million. So out of this, means the total amount is going to be now with us is 217.39 million. Your investment requirement is 200 million, right? So finally, the flotation cost we are going to pay is how much? That is 17.39 million. And finally, from this flotation cost, means you can easily, by paying this flotation cost, you can easily raise 200 million by way of equity, and say still you will be left with the 200 billions of the money or the investment which will be available for the investment to be made in the project. So you call it as the true investment requirements. True investment requirement. True investment requirement would be 217.39 million, and not the 200 million. You have not to go for 200 million. If you raise 200 million, then you will be left with finally 184 million for the investment in the project, which is not the requirement of the project. So you have to raise some amount which is more than the, say, 200 million, which is the exact investment requirement of the project. So if you raise this 217.39 million by following this equation, so finally you will be left with 200 million for making investment in the project, and 17.3 million will be available for paying as the flotation cost for raising the funds through equity. So that would be the correct way. Both are one-time cost. Investment in the project is also a one-time cost, and flotation cost is also the one-time cost. So the correct way is factoring it into the investment cost, means the total cash outflows, rather than into the weighted average cost of capital, because this is the correct way why we say that investment cost is also the one time investment, flotation cost also is the one time outflow, and if you factor it into WACC, that's going to be something incorrect way, because you are mixing up the say something that is a one time with the annual cost, and you are unnecessarily raising the weighted average cost of capital and making even a profit making opportunity as a loss making proposition, and rejecting the investment or maybe the project option or the investment option. So this is the correct way of means factoring the flotation cost and not the other one. So you have to follow this method, and if we take these hypothetical figures here, then against 200 million you have to raise 217.39 million, so that 17.39 million you can pay as the flotation cost and 200 million are still left for the project. Now the next question, which is a very important question here, that here we assumed that total funds you are going to raise from the equity, right? You are going to raise from the equity or the equity capital. But in the real life scenario, it may not be possible that you are going to raise the funds from equity capital only. You are going to raise the funds from the multiple sources, and multiple sources, as I told you, they are four. They are retained earnings plus external equity, right? They can be preference capital, right? And they can be the debt capital, or you call it as the borrowed capital. So these can be the four sources maximum, and if you are going to raise the funds from these four sources, and practically it happens also that, for example, if it is a expansion, diversification or growth project by some existing firm, so and they have some retained earnings also, and retained earnings are safer, maybe easily available source of funding. So every company would like to use these retained earnings first, then they will go for maybe the equity or the debt route, some part. So some part will come from the equity and some part may come from the debt. Or it may be possible if the retained earnings are sufficiently available, so that will make the equity part, and then the remaining part will come in the form of the debt capital or the borrowed capital. So in any way you are going to have the multiple sources of the capital, or at least more than one sources of the capital, unlike the one which we saw in the previous case, that the entire 200 million is going to be equity based funding. So if it is going to be multiple sources based, how to calculate the flotation cost? And in this case, you have to calculate the WAFC, which is called as weighted average flotation cost. You have to calculate the weighted average flotation cost, and for calculating the weighted average flotation cost, what you have to do is you have to use a different formula, and for using this formula you call it as, this is the weighted average of the flotation cost, which we normally call it as small fa, and this will be something like that. You will calculate, you will use this equation, this is the WR, and then we will call it as the FR, and then it will become the WE, and it is going to be the FE, and then it's going to be WP, and it's going to be FP, right? WP and FP, and last is going to be WD, debt capital, and multiplied by the FD, that is a flotation cost of the debt. So you have to calculate the weighted average flotation cost, and for calculating the weighted average flotation cost, you have to take the WRFR plus WEFE plus WPFP and WDFD. So W is basically the proportion of the retained earnings, F is basically the flotation cost of the retained earnings, WE is basically the proportion or weight of the equity capital, external equity, and FE is the flotation cost of the external equity, and WP is the weight of the or proportion of the preference capital, and FP is the flotation cost of the preference capital, and WD is basically the proportion of the debt capital, and FD is basically the say cost of the flotation cost of the debt capital. So for example, we assume here that we take the hypothetical values that out of this total capital 20% is going to come from the retained earnings. So how much is the flotation cost for the retained earnings? It is 0. Because for the retained earnings, we don't pay any flotation cost. Neither we go for any kind of the merchant bank fees, nor for the underwriting fees, or for any other kind of registration fees, no SEBI permission or any kind of the processing fees, nothing, because these funds are easily available with us, and we are going to simply divert these funds from the existing firm to the new project or new venture. So no flotation cost is required to be paid for this particular thing or for this particular source of the capital. Next thing, we assume that we are going to bring 30% of the funds from the equity capital or external equity, and the flotation cost is 10%, right? And then we are going to say the preference capital is just going to be 10%. Preference capital is going to be 10%, so it is 0.1 and multiplied by the preference cost of capital. So the cost here we are going to pay is, the cost for this particular source is, we are going to pay is, this is the 5%. The cost of the preference capital is 5%. So we will take it as 5%. And then the debt capital is the remaining. So how much it is already there? This is 60%, and remaining 40% of the capital is going to come from the debt capital, and the flotation cost for the debt capital is, say you call it as the, we say that is, this is the debt capital, the flotation cost is 4%, we can call it. This is the 4% of the cost of the, when we are going to raise the funds, this is going to be 4% of the say flotation cost. So in case of the retained earnings, the flotation cost is 0, but the proportion is 20%. External equity, the flotation cost is 10%, and the proportion is 30%. And preference capital, the flotation cost is 5%, and this proportion or the weight of the preference capital is just 10%, and remaining 40% of the capital is coming as a borrowed capital, and the flotation cost we are going to pay is the 4% only. So if you sum it up, finally if you solve this, it will become 0, plus this will become something like that 3, and this will become something like that 0.5, and this will be something like that, you will call it as 1.6. If you solve this, it will become 1.6. So this is going to be finally how much? This finally is going to be something like that 4.6 and 5.1. So the flotation cost, weighted average flotation cost is going to be how much? Weighted average flotation cost is going to be, FA is going to be, in this case, the weighted average flotation cost is going to be, when you talk about the weighted average flotation cost, so this is going to be, we call it as FA. So this is going to be 5.1% on the basis of the cost, the flotation cost we are paying to the different sources. So in this case, you can say that weighted average of flotation cost can be calculated like this, and practically in the real life scenario, you get the funds from the multiple sources like retained earnings and the external equity, preference capital and debt capital. So finally, what does it mean? It means that you can convert this into that for raising certain amount of the capital, you have to find out that how much is going to be the total amount to be raised, including the flotation cost. You can easily find out. So it is going to be 0.051, 0.051, and if you find out, this value is going to be something like that, rupees 1.054. 1.054, it means, what does it mean? You can easily say here that for raising 1 rupee of investment, right, you have to raise 1.54 rupees, and this 0.54 will be paid as, 0.54 will be paid as the flotation cost, and 1 rupee will be available as the investment cost. So in this entire process, we learn about that how to calculate the weighted average flotation cost, and practically it happens that in the real life scenario, funds do not come only from the one source, but they come from the multiple sources, and when you are taking the fund from the multiple sources, it means you are paying the flotation cost for those sources. So except retained earnings, you have to pay the flotation cost on all other 3 sources, and if it is to be calculated as the weighted average flotation cost, then for calculating this, we have to use this process, this formula, which is very simple. Finally, for the present case, we calculated that the weighted average flotation cost is 5.1%, which can help us to understand that with the help of this value 5.1%, this communicates us that if you want to raise 1 rupee for investment in the project, as we were requiring 200 million rupees, against 1 rupee of the investment requirement, you have to raise 1.054. You have to raise 1.054 rupees, so that after leaving 1 rupee for the investment, rest of the amount can be paid as the flotation cost, and we are safely raising the funds, which are including both the real investment requirement of the project also, as well as the flotation cost also. So after even paying the flotation cost, we have the sufficient amount left with us, which is the actual requirement of the project investment. So this is how we deal with the flotation cost for the projects, and it's a very interesting concept. So you have to do away with the misconception that you have to revise the WACC, but you have to revise the investment requirement, because both are one time. So it's better to add up the flotation cost into the investment cost or the investment requirement of the project, and finally get to know that for having the minimum, means the expected requirement, investment requirement of the project, how much amount has to be in total raised, including the flotation cost, so that we can get the sufficient amount for the investment and we can easily pay the flotation cost also. So this is the process of talking about or learning about the flotation cost. And now we will move to the next part, and this next part is going to be the next thing, means the concluding discussion on the cost of capital. And the concluding discussion on the cost of capital is that there are certain factors which are going to affect the weighted average cost of capital, and these factors can be factors outside the firm's control and factors within the firm's control. So any factors which are outside the firm's control, you cannot do anything, and you have to pay the increased WACC if they are affecting and they are increasing the WACC. It may be the level of interest rates, they are driven by the market. It can be market risk premium that is not controlled by the firms, and tax rates. So if these three factors are going to affect your cost of capital, we don't have any role to play in this, and we have to deal with that what is existing in the market. We have to accept that, and we have to raise the funds from the sources which are available. But our attempt should be that whenever you raise the funds from different sources, you raise from those sources which are helping us to reduce the weighted average cost of capital. However, there are some factors where we have control. So these are: number one, investment policy, capital structure, and dividend policy. So investment policy and capital structure are interrelated. So when you decide to make investment of certain amount, for example 200 million you want to invest in the project, and you have found out, after all analysis, you have found out that the investment option is a good opportunity and it's going to give us the positive NPV, and expected rate of return is more than the required rate of return. So now you have to go for deciding the capital structure. And when you decide the capital structure of your project, you have to bear in mind that overall cost of capital, which you call it as WACC, that should be maybe within the control or as low as possible. So you decide the capital structure in such a way that you include those sources, means the funds from those sources which are helping us to control the financial cost. But on the other side, you have to be very careful that if you are under the misnomer of debt and equity component, and you say that debt is cheaper than equity, and you want to bring the more amount of the debt as against the equity or the internal funds, so you are going to commit a blunder also, that simply for the sake of minimizing the overall cost of capital, you are putting the firm, the project, into distress. You are raising the funds from the maybe the comparatively lesser costly as against the equity, but they are more distressful funds, sources of the funds. You are making the firm more distressful, and you have to take care of that, because if you raise the funds by way of the debt, you are going to raise the fixed liability on the project's head, and in any case you have to service that debt by way of paying the interest as well as the principal amount. And whether you are earning the profits or incurring the losses, but the debt component has to be serviced, and that can be a problem, that can be a challenge. To be careful about that, that simply don't look at the cost of the capital, just look at the distress level also, and look for the sources of the funds, which keeps the investment easier for the promoters to manage, or for the management to manage. And maybe initially it is expensive as far as the financial cost is concerned, it is more, but over a period of time you can replace the expensive sources with the cheaper sources also. So later on, if the project becomes successful, you can replace maybe part of the equity capital with the debt capital and reduce the financial cost, because at that time you can take some stress also. But initially, if you put so much of the stress by say bringing a larger amount of the funds in the form of the debt, and you bring the fixed element of the cost, in that case the project will become distressful, and sometimes maybe a profit making proposition may turn into a loss making proposition. Second, and the last important thing, is the dividend policy. That also plays a very critical role, that if you require the funds from the profits for the internal use in the funds, so you pay the either no dividend or very low dividend, so that you are left with the sufficient part of the profit to be reinvested back into the business, and you can depend upon the internal sources for your further expansion and growth, and you are not resorting to any external source. So dividend policy also plays a very critical role there. So always keep in mind the investment policy, how much is the total investment requirement. Always decide the optimum capital structure so that cost as well as the distress level also remain under control. And dividend policy, you should design something that if you require more funds internally, then don't pay the dividend, or pay the dividend that should be very, very less, and larger part of the profit should be reinvested back into the business. Now last, while concluding the discussion on, we'll be talking about that how financial institutions calculate the cost of capital. It is a very, very important discussion for us. So financial institutions calculate cost of capital as a post-tax weighted average cost of capital, and that is as per the mix of the funds employed from the different sources for the project. So number one, you have to be careful that it has to be a post-tax weighted average cost of capital, right? And the cost funds coming from the different sources. So financial institutions have some predefined, broadly predefined levels of the cost, and they normally charge this much amount of the cost. So for calculating the WACC, they take into consideration the equity share capital at 15%, cash accruals or retained earnings, they also pay the, means they consider it as the 15%. Preference capital at the dividend rate, that at what dividend rate the firm is going to issue the preference capital. If any kind of the incentive or subsidies from the government, then it's a zero cost. And that we are going to, or financial institutions are count on the post-tax rate of interest, on the basis of the post-tax rate of interest. So this is the say cost of the debt and equity component, which is going to be taken into consideration by the financial institutions while considering the project for lending the funds. So they can say that out of the total cash flow available, or maybe the funds available with the firm, they will have to first pay the debt. So they have to pay the post-tax interest rate of the debt they have to take into consideration. And then they will say that equity means a requirement, or maybe the equity return on the equity to be paid would be something around 15%. And similarly, when you talk about the debt, debt is including say the long-term loans, non-convertible debentures, deferred credits, bank borrowings for working capital, and unsecured loan from the public. All these are put together at the same time. And if there is anything coming from the convertible debentures, then convertible portion at the 15% will be counted, because it will become equity, right? 15% it will become, because it will become equity, like equity, you are converting that debentures into equity. So they will be counted at 15%, and remaining non-convertible portion will be as per the post-tax interest rates. So because when we are going to the financial institutions for seeking the funds from them, so we'll have to explain it to them that what is our capital structure, so where we are going to raise the funds from, what is the expected cost of the capital, or maybe the interest rate or dividend rate we have to pay back to these different sources, and how our project is going to be financially viable, so that if you give us the funds, or you invest into, or you lend the funds to us, your funds are going to be safe with us, because we are going to return good return to the equity shareholders also, to the lenders also, and to any amount to the subscribers of the debentures or the bonds also. So overall sustainability, financial sustainability of the project has to be checked by the financial institutions before lending any money, and for them the different dividend or interest rates to be worked out for their own internal cash flow analysis will be something like this. And now lastly, we will look at that when we calculate the cost of capital. Practically, how do we calculate it? We take the hypothetical figures for that for any project. The total investment coming from different sources, and the total investment requirement is of this is 2,600 millions. And in this 2,600 millions, 900 million is coming from equity. Preference capital is giving us 100 million, and the term loan are giving 800 million. Non-convertible debentures are giving us 400 million. Convertible portion is giving us 100 million. Non-convertible is giving 100 million, and bank borrowings are going to be for the working capital requirements 200 million. And the cost of funds is going to be something like this. That is, cost of funds is 15%, 10%, this and this. All these are going to be the interest rates. So finally, the cost of funds which we have calculated post taxes. So 135 you need to pay to the equity shareholders, 10 to the preference shareholders, then rupee term loan we have to pay 84 million. And then you have to pay the non-convertible debenture 36 million, convertible portion 15 million, and non-convertible you have to pay 7.5, and finally for the bank borrowings you have to pay 22.5 million of the total amount on the amount we are going to borrow. So it means in this case for borrowing or raising 2600 million at the rate of maybe at the different rates of borrowing, so the total cost of the funds will become 300 million and the total amount to be raised is 2600 million. So the average cost of capital post tax is going to be 11.92%. Average cost post tax is going to be 92%. So this way normally we can calculate the cost of capital for the different sources where the funds are going to come from, and we have the defined or maybe pre-accepted cost of the capital or the rate of return to be paid or to be earned. And finally we are going to raise, for example in this case 2600 million, which is the investment requirement of the project. So finally we are going to pay, we are going to pay 310 millions of the cost funds, and if you work it out as the average cost of capital post tax on this total investment and this financial cost, so this average cost of capital is going to be 11.92%. So this is all about the cost of capital, which is a very, very important component for any investment option, whether it's a new, old, or maybe if it is a expansion, diversification, or a growth project. Cost of capital plays a very important role. So for finding out whether our investment option is giving us the positive NPV, negative NPV, or sufficient IRR, or maybe the say this you call it as the benefit cost ratio. So in that case we will have to have a certain maybe outputs, and these estimates are in the form of the cash flow estimates, and then we have to have the cost of capital. So the cash flow estimates will be used for knowing about that how much is cash flowing out for building up this project or this venture, how much cash will flow over the subsequent number of years for the foreseeable period, and for discounting of those cash flows you need the R, that is the discount factor. R would be basically the weighted average cost of capital. So cash flow estimation was important, cost of capital, weighted average cost of capital is also important, and if you have both these components in your hands, easily you can find out the present value of the cash flows and can say that NPV of the project is either 0, positive, or negative, or IRR is more than the, you call it as the required rate of return, less than required rate of return, or equal to the required rate of return, and finally we can take a decision whether to accept that investment option or to reject that. And if it is a positive NPV or at least 0 NPV, you will accept it, otherwise you will reject the project proposal. So cost of capital, apart from the many other things, is equally important, and that's why we learnt in detail that how to calculate the cost of capital, or what is the concept of the cost of capital, and how to calculate the weighted average cost of capital, including the flotation cost, and how to finally arrive at the financial cost for evaluating the new investment proposals. So for the moment we will stop here, and in the next class or the next class onwards we will start talking about the risk analysis of the new investment proposals or the capital budgeting or new investment projects. Till then, thank you very much.